ECA framework for weak banks may come up for discussion.
Congress chooses old guard Kamal Nath as Madhya Pradesh next Chief Minister to be sworn in on December 17th, but deliberations continue for Rajasthan, Chhattisgarh. Decision likely today. Well, a look at the Asian markets. They're not doing too well in trade today. They're trading in negative territory, about 1.5% shaved off both the Nikkei as well as the Kospi, and this on the back of a decline that has come in from the European markets as well as the Wall Street. A mixed session on Wall Street was on the cards overnight. Remember, the ECB president trimmed the growth forecast for the Eurozone region to 1.9 from 2%. Also, a slew of data from China is expected, so the street is on tenterhooks ahead of that mild strengthening seen in the dollar yen. The data that is awaited from China are the likes of production, retail sales as well as fixed asset investment. SGX Nifty on the back of that indicates a mildly red tick. Remember, over the last 2.5 trading sessions, we've gained about 460, 470 points for the Nifty itself. Looks like some bit of gains are being given back at the open itself, down about 50 points. And keep an eye out on crude as well, up around 3% in overnight session, around the $61.50 per barrel mark.
Okay, well, let's tell you about the US markets then. Stocks closed mostly lower after what was a volatile session. The Dow closed 70 points higher. The S&P fell marginally, while the Nasdaq composite dipped 0.4%. So it was really a mixed session. This is as Amazon and Alphabet gave up their initial gains. US-China trade concerns continue to dominate, and signs that the Chinese were ready to make significant concessions to their industrial policy and reduce tariffs on imported autos. CNBC's Deirdre Bosa gets us a wrap of all what took place on Wall Street.
U.S. stocks finishing the session mixed. The Dow up 70 points, the S&P flat, and the Nasdaq down 27 points. The number of Americans filing applications for jobless benefits falling to a near 49-year low last week. Initial claims for unemployment benefits dropping to 206,000. That is a big fall from the previous reading and well below what economists were expecting. That decline in claims is the largest drop since April 2015. Casino stocks getting hit today after famed short seller Jim Chanos telling CNBC that he's down on Las Vegas Sands and Wynn Resorts. Chanos says those companies could get caught in the middle of the U.S.-China trade war, saying China could hurt their operations in Macau. Any disruption there would be felt by investors. Shares of both companies finishing the session lower. Starbucks is partnering with Uber Eats to deliver lattes and frappuccinos to customers. The partnership will extend to about a quarter of Starbucks U.S.-based company-owned stores by the end of the second quarter. The company already has a delivery program in China. That's the action from the U.S. market. Back over to you in Mumbai.
All right, Starbucks partnering with Uber Eats. Must tell you that this is Starbucks is slightly late on that in India. Cafe Coffee Day actually partnered with Uber Eats about a few months ago itself. In fact, on that note, let's also hear out some opinion coming in from Wells Fargo and JP Morgan on the road ahead for the US market as well as the Fed's rate trajectory.
Just seems like, the Fed is at a point right now where it can really kind of feel its way along. It doesn't have to be on this preset path of, of hiking rates. And so, we'll think you'll see slower rate hikes next year. And we think by the middle of next year, they'll pretty much be done at that point. If growth comes in as we expect, and so for overall 2019, we're still looking like at 2.5% in real terms. But if it actually slows down more than that, I mean, you could potentially see, 1 and, potentially 0. Do believe that profit growth is going to slow. So, I mean, if you're looking at before tax profits, and this would be all economic profits in the entire economy, it's going to grow about 8% this year, and we're looking for about 5% growth next year. Now, whether or not that's factored into the market or not, I'm not going to opine on that because I'm not a stock market strategist. But we are certainly looking for slower growth in profits in 2019, and then about flat growth in profits in 2020.
If the economy continues to deteriorate, I would suspect that we can see those multiples come down further. But I think right now what's really in focus is 2019 earnings and the fact that consensus is still calling for a pretty high number. Globally, we're looking for 8% earnings growth. And given the economic slowdown that we're seeing, given the tightening that we're seeing, given the yield curve developments in the United States, and of course not to mention trade wars, I think that 8% EPS number for 2019 looks a little bit high. So that's what I'm I'm watching really closely is what happens to earnings revisions, because at this point, I think that's what's going to drive market more than valuations.
Okay, some encouraging data on the jobs front out of the US. Latest weekly jobless claims have fallen to a 49-year low of 216,000. But that does not mean that Americans are not concerned about the state of the economy, especially with trade wars and looming rate hikes. CNBC's Steve Leisman takes a look at how that is affecting spending, especially this holiday season, in the All-American Economic Survey.
Americans plan to spend record amounts for the holiday this year, even while their views of the economy fell strongly from record levels. The CNBC All-America Economic Survey found that holiday spending plans topped $1,000 for the first time in the 12-year history of the survey, rising to a record $1,100 with gains spread across income, age, and regional groups. The survey of 800 Americans nationwide has a margin of error of plus or minus 3.5%. Respondents reported that those higher spending plans are largely the result of higher incomes, showing that rising wages and better employment, which is shown up in the economic data, will mean more and maybe even more expensive presents under the Christmas tree. Yet the survey also found that views on the economy fell the most in the survey's history. The assessment of the current state of the economy dropped a record 8 points on a quarter-to-quarter basis, with just half of the public saying the economy is excellent or good. And the percentage saying the economy will improve in the next year fell 5 points. Both numbers, however, remain at relatively high levels and might reflect a sense that the economy has slowed or that it can improve much more from here. The recent sell-off in the stock market dampened American views on the outlook for equities and depressed overall economic optimism. But the message is clear. Santa's sleigh should be laden with overflowing bags of presents this Christmas. But next year, he might be traveling just a little bit lighter. Steve Leisman, CNBC Business News.
All right, let's move across the Atlantic then. In Europe, stocks ended lower as the European Central Bank formally brought its 2.6 trillion euro QE quantitative easing program to a close. So about 0.25% shaved off the CAC as well as the FTSE and the DAX, which ended just below the red line.
All right, and let's update you on what took place in the euro. The euro dipped after the European Central Bank formally ended its bond buying program. CNBC's Annette Wiesbach reports on the ECB's decision to end the crisis-era stimulus.
It was an historic day for the ECB because it's the official announcement that QE will end at the end of this year. At the same time, Mario Draghi was quite self-congratulatory about the effects of the QE program in the past, saying that for certain times it was the only growth driver here in the Eurozone. So, looking ahead, it will be quite an interesting year to come because clearly Mario Draghi during yesterday's press conference turned more dovish. We've seen a direct reaction on the forex market. The euro went sharply lower when Mario Draghi was stressing the risks to the economic outlook more pronounced than previously, saying that incoming data was weaker than expected. But take a listen of what he said exactly.
That, in a sense, that was the focal point of the Governing Council discussion. What sort of assessment would the Governing Council give about? And if I have to draw a conclusion about the sense that transpired from the discussion, I would summarize it with just few words, namely continuing confidence with increasing caution.
For now, the ECB is reiterating that they have enough instruments to also weather another economic downturn, and they can easily expand everything, including QE, which is now in the normal toolbox, he was stating. So essentially, Mario Draghi and his team will head into a very difficult year because they're trying to put the foot off the pedal of monetary policy stimulus, but at the same time, the economy is sort of deteriorating slightly, which is also mirrored in their staff projections. For now, they stand put and do what they have promised, but when the first rate hike will be here in the Eurozone, that's currently not really foreseeable because markets are pricing it further and further into the future.
All right, in the currency space then, the dollar holds on to gains against most major currencies on the back of optimism on some progress between China and the United States to resolve their trade issues.
In the world of commodities, crude oil edges higher on the signs of tightening oil supply. This is after reports of Saudi Arabia planning to slash exports in the US in the coming weeks. Markets continued the up move but ended off the high point of the day. So the markets had surged above 10,800, couldn't sustain those levels. But nonetheless, it's been a really strong recovery from the lows that we've seen on Tuesday for the Nifty. The Nifty just ended shy of that 10,800 mark, while the Sensex gave up the 36,000 mark in the last hour of trade. Broader markets also slightly outperformed, with the Bank Nifty and the mid-caps rallying about 0.7%. But Mangalam, FII's bought also in yesterday's trading session, so maybe that allayed some more concern.
Absolutely, that was one of the bigger data points. But while we did not manage to hold on to the 10,800 mark yesterday, it is important to know that from Tuesday's lows, the Nifty has gained about 460 points or 4.5%. The Sensex has moved 1,500 points, again 4.5% gains out there. The banks have moved higher, so a 5% move on the Nifty Bank, about 1,200 points out there. And the mid-caps, you spoke about the mid-caps outperforming yesterday. Not only yesterday, over the last 2.5-3 days, the mid-caps have outperformed, nearly 7% gains on that index itself from Tuesday's lows. So that was a positive. Another positive, like you said, was the FII purchase. So after 2 days of pulling out around 3,700 crores from our markets, the FII has put in about 675 crores, or about $100 million in the cash markets. The domestic institutional investors sold about 52 crores, so the net flows were positive. However, that FII cash flow has to be taken into context. It could have been much lower than expected, primarily because New York Life Insurance bought about 215 crore worth stake in Max Financials. So that was the data point that was included in the 675 crore purchase as well. X of that, the purchase would be anywhere around 400 to 450 odd crores. But the futures don't lie. FIIs in index futures, after selling about 1,100 crores yesterday, ramped up, bought about 2,400 crores after the sharp up move that we've seen. While we saw an addition of close to 17,000 longs in index futures, the FIIs also covered 15,000 shorts in index futures. And that is a big data point, because the FIIs, just the previous trading session, were 43% long or 57% short, and now they're 47% long. They're still net short, so further up moves can cause further short covering. However, important levels to watch out for on the Nifty: the series high and the 100-day moving average have been same at around the 10,941 mark. That is something we'll have to keep an eye out on. And then we have the series closing high of 10,884. So the Nifty failed to sustain above 10,800 yesterday. Let's see where it goes. At the lower level, though, we have some support coming in at the 200-day moving average, 755. That is where it is. And below that is the 20-day moving average, 10,700. Big cues over the next couple of trading sessions. Brent is back at $61.5 per barrel. ECB president has trimmed the growth forecast for the Euro region. So that's telling you global growth is slowing down. Chinese economic data due today. So let's see whether there is some slowdown out there as well or not. And finally, we have the US Fed meet next week. Let's see what happens.
Okay, and stocks?
Stocks today, I'll be watching out for a lot of the public sector banks, in specific the PCA related banks, because there is the RBI board meet today where PCA norms are likely to be discussed. All the more important given the commentary that has come in from the government side as well. Another stock I'll be watching out for is IOC. They've announced a buyback of 3.1% of the company's equity. So that's the acceptance ratio, 149 rupees a piece, and the current market price of the share is 137 rupees. Dilip Bilkon, there has been a rating downgrade on the stock over the last couple of quarters. The balance sheet has deteriorated, so let's see how the street takes that as well. Adani Enterprises, interesting acquisition. They've acquired stake in Alpha Design Technologies, which is a defense firm, for 400 crores. But if you take a look at their revenues, it has been 218 crores in the previous year and a net profit of just about 8.5 crores. So let's see how the street takes this. IEX and Dhanuka Agritech, both of them will see a board meeting on December 20th to consider buyback.
Okay, all right, Mangalam. Thanks very much for that. Take a break. But up next, the big story. Piyush Goyal questions PCA framework and RBI's capital reserves. In a fresh twist in the ongoing differences between the government and the Reserve Bank of India, Railway Minister Piyush Goyal has hit out to the central bank. In a series of tweets, he questioned the rollout of the prompt corrective action framework, saying it was an unreasonable amendment and the decision was taken by RBI without a go-ahead from its central board or government. Speaking on the capital framework, Goyal said that RBI's reserves are not being put to good use and instead should be used to capitalize weak banks. However, we understand from sources the Reserve Bank of India had in fact discussed the PCA norms with the Finance Ministry before the rollout. Ritu Singh joins in with the details. Ritu, morning.
Morning, Ekta. Well, yes, at least 3 letters were exchanged between the Reserve Bank of India and the Department of Financial Services within the Finance Ministry before the rollout of prompt corrective action norms. So as per the sources that we have spoken to, it would be completely inaccurate to say that the government was not made aware of the changes in the prompt corrective action norms that the RBI introduced on the 13th of April 2017 finally. We do understand from the sources that we've spoken to that the first letter was written to the Finance Ministry on a revision in the prompt corrective action norms sometime in early September 2016, and the Finance Ministry in a 3rd March letter responded to that and alluded to the September letter saying it was broadly in agreement, and these are the terms used in the letter. They are broadly in agreement with the revised prompt corrective action framework. However, the Finance Ministry officials did suggest some safeguards. They also sought clarity from the RBI on certain provisions of the PCA. They wanted to ensure that, if there's a sudden spurt in, say, provisioning and the tier one ratio falls, then that should be taken into account by the PCA norms. All of these clarifications, were responded to by the RBI in their last letter, which they sent to the RBI sometime in early April, telling them that they would now be going ahead with the revised PCA norms, which are then made public and released on the website on the 13th of April 2017 after several consultations with the government. So, if one were to say that as the tweet from Piyush Goyal suggests that the government was not kept in the loop, it would be fairly inaccurate to say that because the government itself had indicated that it was in agreement, at least at the time of the rollout of the prompt corrective action norms.
Okay, all right, Ritu, thanks very much for that. But we have Lata joining in also with her assessment on the minister's comments as well as what can be expected in the Reserve Bank of India board meet later today. Lata, morning.
Well, in the first place, as Ritu was pointing out, the first thing we have to take is that government is putting all pressure it can on the Reserve Bank, whose board is meeting today, to ensure that the prompt corrective action framework is diluted or maybe totally done away with if you go by the ferocity of the comments made by various ministers, especially Piyush Goyal. So it bears down heavily on an entity appointed by the government. So they can't not take the sovereign's views into consideration, especially when it is so vociferous, in a way that crimps the regulatory freedom. The regulator knows how weak banks are and why those constraints were put in. And as the second point is what Ritu pointed out, that the government was in the loop. And in any case, that is an April 2017 rule. Why is it that in December 2018, after losing 3 elections and with a poll in front of you, there is this frontal attack? So that itself will give civil society and citizens a little bit of fear whether the government is asking rules to be loosened ahead of the polls and whether that liberty will be misused by the public sector banks, again under pressure from the government. That's a second worry that comes to the mind. The whole timing of the attack, because as Ritu pointed out, the government was very much in the loop in April 2017. And the third worry the third factual error is to say that PCA norms don't exist anywhere. On the contrary, they are stricter in other countries. In the first place, in other countries, when there is a bad loan, it is 100% provided the moment a loan is not paid off. In India, we provide 15% in the first year, 30% in the second year, 40% in the third year. So we have under-provided bad loans, and that is why you end up having this PCA framework where net NPA over 6% is brought under PCA because most of the loans are not provided for. And that's why you have these kinds of standards. Yes, in other countries, the only standard for PCA is if capital falls. But the other thing to note is in the US, once capital falls below the threshold, it's not just that you're put under prompt corrective action. The a regulator takes over the bank and sells it off immediately to a new buyer, because you can't allow an undercapitalized bank to do business. They are stopped from taking deposits and giving loans. So each country has a different milieu. And in our country, since you cannot sell off a government bank and you don't have very strict provisioning rules, we have a different filter for PCA. So it's factually incorrect to compare it to other countries and say things are, easier or looser in India. Each country's regulator responds differently. But the sum and substance for us today is that coming as it does on the day of the Reserve Bank's board meeting, which is going to discuss prompt corrective action, it does look that the central bank has no option but to give in largely to what the government is asking.
Okay. All right, Lata. Thanks very much for that. In fact, definitely those PCA banks will be in focus today and probably see some upside. But we also spoke to a whole host of experts to get their perspective on the relaxation of PCA norms. Listen in.
This discussion is about capital. It's not really about PCA. If banks were properly capitalized, everyone wants them to lend in the market. That's how they will make money. And so it's important that they have the requisite cushion so that their depositors are not at risk. Because one way or the other, if any of these banks fail, which are government owned, the government will have to pay for it. Either it will give them capital or it will have to bail out the depositors. So I don't think there is this particular, some of these issues have just become contentious without real purpose. How much is Dena Bank and Bank of Maharashtra as a market share of banking in India? What, 1.5%, something like that? Really small amounts, and how much are they in credit? Again, very small. So, how much of an impact is Bank of Maharashtra and Dena Bank having on credit growth in the country?
The PCA yardsticks are not incorrect or bad. But let us reconcile to the fact that 2 years of losses at the net level do not mean that they are operating losses also. So they may be having an operating profit. Why the losses are coming? Because of the NPAs and NPAs aging, the provision requirements have become progressively very high. Banks are not expanding their books.
Okay, well, we still have Lata with us because we have that RBI board meet taking place today and she joins in with her expectations from that. Lata.
Well, three major expectations, prompt corrective action, prompt corrective action, prompt corrective action. So that's the most important thing that will be discussed. There is a small chance that the members of the committee that will decide how much capital RBI should have may also come up in the board meeting. The initial announcement made by the government and the RBI was that the committee will be set up with the government and the RBI in consultation with each other. So when they say RBI, do they mean the board? We don't know, but it could well come up for consideration. And something on MSME could also could be discussed, though again in the previous monetary policy, the Reserve Bank had announced that they are setting up a committee to give more aid, to check out ways in which the MSME sector may be helped. So I don't know whether that will be rehashed since a committee is anyway going into it, but that could well be another discussion point. But the most important one is RBI governance itself is going to be discussed, which means the chances are they're going to set up various committees, each of which will shadow each activity of the Reserve Bank. Already there are two such committees, the Board of Financial Supervision and the Payments Committee. The Board of Financial Supervision is largely comprised of RBI members, the deputy governors, and the governor chairs it, and there's one external member. But there could be more such committees shadowing different actions with more external members going by the tenor of the board and the government's approach. And on this issue, while the previous governor may have even actually resigned on this issue, found it unacceptable. When we spoke to the new governor, Shaktikanta Das, he said, yes, the Reserve Bank has to be autonomous, but it also has to be accountable. So it looks like now that battle has been given in by the Reserve Bank.
Okay, all right, Lata. Thanks very much for that. So definitely.